All right, let's jump right in. Today, we're going to talk about something that feels, well, a little too familiar. It's like a weird financial deja vu, a potential echo of the crisis that absolutely rocked the world. We're going to look at the case for what some are calling the Big Short 2.0. And this quote, man, it just nails the whole idea we're exploring, doesn't it? The argument is that the financial world might just be watching a rerun of a really scary movie. So the big question for all of us is, will we recognize the plot this time around? So to even begin to understand what might be happening now, we've got to start with the original cast of characters. You remember The Big Short, right? That small handful of investors who saw the 2008 crash coming when literally no one else did. So the billion-dollar question is, what are they up to now? Okay, so picture this. It's 2006. Michael Burry, this guy nobody really took seriously, walks into the biggest banks on Wall Street. And what does he do? He makes this insane billion-dollar bet that the entire US housing market is going to completely collapse. I mean, they literally laughed him out of the room. But just 2 years later, when the global economy was in free fall, who was the genius? He was. And now, after 17 years, he's back. And his new move is, wow, it's just as audacious. Burry has taken a massive short position, which just means he's betting the stock price will tank against the two hottest stocks of the entire AI revolution. This is a bet of epic proportions. I mean, if he's wrong, if these stocks keep soaring, he could get completely wiped out. But here's the thing, he's not alone. Another major player from that 2008 story, who our source just calls Dell Bank, has also started betting against AI stocks. And get this, they're apparently telling their clients they've built a new financial product that is identical to the one from 2008. They're claiming the old script is playing out again, word for word. So, if we want to understand the danger they say they're seeing today, we have to go back. We need to really break down the blueprint of that last crisis. How exactly did that 2008 financial machine actually work? It was basically a four-step machine. Step 1, banks were just handing out money to anyone. No job, no income, no problem. Here's a mortgage. That created this massive housing bubble. Step 2, they took all these super risky subprime loans and kind of mixed them up with some good ones, packaging them into something called a mortgage-backed security, or MBS. Step 3, and this is the crazy part, they paid the rating agencies to slap a big, shiny AAA rating on these things. That's the highest safety rating you can get. And finally, step 4, they sold these supposedly safe packages to everyone else. Pension funds, regular investors all over the globe. So the whole trick, the core mechanic, was this. The banks made a ton of money right up front, then they wrapped up all the potential for disaster into a neat little package and passed it on to somebody else. They privatized all the profits and socialized all the risk. Okay, so how on earth does that connect to what's happening today? Well, the source material we're looking at argues there's a new financial weapon at the heart of the system, and it's all built around the AI boom. We're talking about data centers. Does this sound a little familiar? Here's the modern playbook. Step 1. The AI giants lease their massive data centers instead of buying them. They do this through what are called shadow banks, basically non-bank lenders, so they can keep billions of dollars of debt off their official balance sheets. Step 2. These shadow banks take the lease agreements and bundle them into bonds called special purpose vehicles, or SPVs. Step 3. Yep, you guessed it. These SPV bonds also get a AAA safety rating. And step 4, they're sold to the exact same buyers, pension funds and insurance companies. And this really is the heart of the argument. The names have changed, the tech is brand new, but the financial playbook, it's exactly the same. The profits go to a select few, while the real ultimate risk gets shoved onto the public. Okay, let's really nail this down. Let's put the two eras side by side and see just how identical this script truly is. This table just lays it all out, plain and simple. Back in 2008, the borrower was a homeowner with a shaky income. Today, it's a massive AI giant. The lender was a big commercial bank. Today, it's a shadow bank. The asset was a mortgage on a house. Today, it's a lease on a data center. The supposedly safe product was an MBS. Today, it's an SVP bond. But look at that bottom line. The person left holding the bag, the ultimate risk bearer, in both cases, it's the public. Okay, but here's the question I know you're all thinking, right? This is the big pushback. We're talking about AI giants here. Some of the richest, most powerful companies in the history of the world. They're not like the borrowers from 2008. There's no way they could fail to pay their rent. Is there? Well, according to the source material, the answer is pretty shocking. Some analyses of leading AI companies like OpenAI has shown a mind-blowing cash burn. Some reports suggest that at certain points, for every dollar they earned, they spent 14. That's a staggering negative operating margin. So the source asks a pretty pointed question. How is that kind of financial fragility really any different from the subprime borrowers of 2008? And there's another huge difference here, one that actually makes today's situation potentially even riskier. It's the collateral. Think about it. A house, even if the market crashes, is still a house. It's a physical thing with real long-term value. But a data center? It's full of computer servers and GPUs that are basically worthless in 3 to 5 years. The value of that collateral just plummets to near zero, and it happens fast. So this all leads us to the most important question of all, especially for anyone with a retirement account or an insurance policy. If this whole structure is as rickety as this analysis suggests, who's left holding the bag when the music finally stops?
Let's just be blunt about it. If these bonds are a ticking time bomb, who's actually holding it right now?
So who's holding it? You guessed it. It's us, the public. And look, even if you've never heard of an SPV bond or bought one yourself, your money is probably in this game. Your pension fund? They've likely bought them. Your insurance company? Yep, they're probably invested. We're talking about huge national retirement systems. In the US, the UK, Japan, South Korea, all of them have reportedly greenlit investments in this exact type of thing. And this is the crucial part. The main players have built-in escape hatches. The AI companies are just tenants. If things go south, they can just walk away from the lease. The shadow banks are just brokers. They already sold the bonds and pocketed their fees. So when the bill comes due, they're not the ones who are going to have to pay up. Look, at the end of the day, this analysis isn't really about predicting the exact moment a bubble might pop. It's about something more important, understanding the game that's being played. According to the source, the real key is to simply understand the rules and how it all works. Which leaves us right back where we started, with one big, nagging question. If history is truly handing us the exact same script, can we really honestly expect a different ending this time? That's something to think about. Thanks for tuning in.